Having a good credit score is based on having a good credit history, and it can lead to lower interest rates when you apply for loans, including car loans, personal loans, and mortgages. It also makes lenders deem you more trustworthy, as they've seen that you have a good history of paying things back and will be more likely to approve you for the loan. In this video, we're going to be talking about what exactly makes up your credit score and how you can use credit cards as a bridge to help you build your credit score quickly. So, your credit score is made up of a couple factors, as you can see here. The biggest factor at 35% is payment history. Having a good track record of payments generally means that you're going to be paying your money back. And as you might imagine, lenders' first priority is to ensure that they get their money back. Having a couple late payments here and there won't ding your score too much, but of course it's best to have no late payments. Turning on auto pay goes a long way to ensuring that you have no missed credit card payments. Even if you forget to check your statement for 1 or 2 months, you know that auto pay will withdraw the money from your bank account and you don't really have to worry. The next biggest factor at 30% is amounts owed. This includes a couple sub-factors. So some of the more important ones include the credit utilization ratio and how many accounts have balances. Now, credit utilization ratio is the ratio of the debt you have versus your credit limit. So say you have 2 credit cards whose limit combined is $5,000. Now, if you have, say, $1,000 of debt on the both of them combined, then your credit utilization ratio is 1,000 divided by 5,000, or 20%. Having a low credit utilization ratio obviously goes a long way into ensuring that your score is lower. The general guideline is to be under 30%, but I'd recommend to be under 10%. So this is somewhere where having more credit cards can help you. If you have more credit cards, you have a higher credit limit, and therefore your ratio, even if you spend the same amount of money, is going to be the same. But of course, there's some risk that, if you have more credit, you're going to be spending more irresponsibly. So that's just a fair warning. Please spend responsibly with credit cards. Don't buy anything that you normally wouldn't. And finally, there is your length of credit history, your new credit, and your credit mix. So these 3 together make up 15%, 10%, and 10% of your score respectively. So what length of credit history is how long you've opened up your account. So this includes your oldest account, your newest account, and the average age of all your accounts. The average age of accounts being the more important one. When you begin, you might not have any sort of credit history. So if you know someone you're close to who has a long credit history and has no missed payments on a certain credit card, maybe reach out to them and ask if they can add you as an authorized user. We'll talk about that a little bit later. New credit means how many hard inquiries you've made. So there's 2 types of inquiries. There's a hard pull and there's a soft pull. Now, soft pulls don't do anything to affect your credit score, but hard pulls will. Hard inquiries are normally performed when you're applying for a new line of credit or some loans. They stay on your credit history for 2 years, but really only effective for 1 year. They just decrease the credit score temporarily. So if you know that you're going to be applying for a mortgage or you're going to be applying for a car loan in the near future, it might not be the best idea to apply for too many credit cards in that span, as it can negatively impact your score and make lenders not want to let you borrow money. And now credit mix means the types of accounts you own. So whether that be credit cards, home equity line of credit, mortgages, etc. I've actually seen that someone's scores have gone up when applying for a mortgage just because they have a different credit mix and different kinds of credits. So that's just an overview of what credit score is made up of. And now we're going to be talking about how you can leverage credit cards in order to rapidly increase your credit score. But before we get into that, if you're enjoying the content so far and find it to be helpful, please like and subscribe, as it really helps to grow the channel. Thank you. So, as promised, here's how you can use credit cards to help you out. So the first thing when you're starting out in your credit card journey is try to get a family member or someone you're close to add you as an authorized user. If you know someone who has a credit card with a long history of payments, think maybe 10 plus years, honestly anything will really help, and having no missed payments, just reach out to them and ask. What an authorized user means is that you'll get a card with your name on it, but any spending that you do, they'll have to pay for. And of course, do this responsibly. They were already nice enough to add you as an authorized user, so if you incur any expenses, make sure to pay them back. And it's best not to incur any expenses. You're just getting that for the credit history. So now you'll have their credit history on your account. So it'll help with a lot of things. It'll help with your payment history, your credit history, because you'll have no missed payments on file and a long account age. And just some generalized guidelines. Please turn on autopay as soon as you get a credit card. You don't want to accidentally miss a payment, have a late payment, and having that late payment blow up in APR and you paying 1.2x, 1.3x more than you would have if you turned on autopay. This also, of course, helps with your payment history. This ensures that you're never going to miss a payment, which, yes, you should never miss a payment when you're working with credit cards. Another guideline is to always pay your balance off in full every month. So you can always do this in auto pay as well. Just click payment as full statement balance at the end of the month. And that makes sure your balance is never going to appreciate or hit the APR. And finally, don't spend more than you usually would. One risk that I acknowledge of credit cards is that you have a higher credit limit. It's not taking directly out of your bank account when you swipe your card, so it doesn't really seem like the money is leaving your account. But please just treat it as a normal debit card. You're getting the credit card rewards already, and using it responsibly will reap you benefits in the long term. So, what if you don't have someone in your life who can add you as an authorized user? Well, there's always the option of starting off with a secured card. So what a secured card means is you generally give the bank some sort of deposit, say $200, and that's going to be your starting credit limit. The lender or bank will generally keep this deposit just in case you don't pay the bill. You'll get it back after a good history of payments, or if you upgrade to an unsecured card or eventually close the card. These sort of cards are generally best for people looking to rebuild their credit or looking to build their credit altogether. Lenders will be more likely to approve you for secured cards. This is because they have your credit line in terms of deposit, so it's really no risk to them. Some example of good secured cards include the Discover It secured card and the Capital One Quicksilver secured cash rewards credit card. Man, that's a mouthful. So once you've moved on from secured cards and have a good payment history, you can move on to student cards or no annual fee cards. So student cards are generally for people in college, and it's a step up from secured cards in that you're going to be earning some sort of rewards. Generally, secured cards have no rewards. They're just a credit card that acts as a debit card. So student cards are now unsecured cards. Some recommendations I have in this category include the Discover It Student Cashback, which will give you 5x on rotating categories. This was one of my first credit cards. And the Bank of America Travel Rewards for students, that gives you 1.5x back on all purchases. And this was actually my first credit card that I ever opened. Some other good options also include the Chase Freedom Student, the Capital One Saver One student credit card, and the Capital One Quicksilver student cash rewards card. And then we have the no annual fee cards. A lot of this is similar to a student card. You'll get some of the same rewards. It's just that there's some age restrictions for these student credit cards. Some of the cards I'd recommend in this category include the Citi Double Cash, which gives you 2% cash back on everything. The Chase Freedom Flex, which gets you 5x back on rotating categories. And right now they have an intro offer of 5x back on gas stations for your first year of card ownership. Another one I'd recommend is the Bank of America Customized Cash Rewards card, which gives you 3x back on the category of your choice and 2x back at grocery stores and wholesale clubs. One other recommendation I have in this category is the Wells Fargo Autograph card. This is actually a recently released card, which is similar to the discontinued Wells Fargo Propel. it earns 3x back at a lot of different categories actually. So these include restaurant, travel, gas, and groceries. So this is actually a really good catch-all card. And after a couple years, and maybe you don't even need a couple years of using these no annual fee cards, you might want to ask yourself, is there any more annual fee cards I could use? And of course there are. So annual fee cards generally also come with some sort of credit. You can transfer your rewards points to travel partners and generally have more high-end redemption options. Now, I won't talk about any of these specifically in this video, so do your own due diligence on whether you should apply for these cards, make it make sense for you. But some of the cards I would recommend you look at are the Chase Sapphire Preferred, the Amex Gold, I actually just made a video about that, link up there, the Amex Platinum, and the Capital One Venture X. Now those first three I mentioned, the Sapphire Preferred, the Amex Gold, and Amex Platinum, are cards I all use and would highly recommend. And the Capital One Venture X is a card I would like to have, but Capital One just doesn't seem to want to approve me. But I would recommend it for anyone looking to get a premium travel card. Even if you don't get those higher end cards like the Sapphire Preferred and the Amex Gold, it really won't matter too much as long as your other cards, you have a good payment history, you have a low credit utilization ratio, and you're not applying for too many cards at once. So this is my advice on how to leverage credit cards in order to build your credit score up higher. First and foremost, having an authorized user goes a long way to bumping up your credit score. It can bring you up to the 700s very, very quickly. And once you have that history, you can just leverage that. You can open more credit cards in your name, which will increase the number of credit accounts that you have, and in turn, help to increase your credit score. And as always, make sure to always make your payments on time, always make your payments in full, and never pay more than you normally would with a debit card. So these are the 3 guidelines I'll leave you with. And if you have any questions about any of the things I've talked about in the video, whether it be regarding your credit score or recommendations on a credit card that just came out or something that I didn't mention in this video, please feel free to drop a comment below. I'll do my best to get back to you. And as always, if you enjoyed the video and found it to be helpful, please consider liking and subscribing as it really helps. Have a great rest of your day. Thank you.